On January 30th, 2026, something happened in the silver market that almost nobody was prepared for. In a single day, silver didn't just fall, it collapsed. The price plunged from $121 per ounce to just $70. That's a $51 drop in hours. A crash so violent, it erased more than $7 trillion in global market value. Traders were liquidated, portfolios were destroyed, and across the world, physical dealers reported something even more shocking. They had no silver left to sell. So how does a metal crash like that, while physical inventory disappears at the same time? How does price collapse? In the middle of a shortage? And who actually profited from one of the most violent silver crashes in history? Because while millions of investors were losing money, one man was making a fortune. The billionaire who saw it coming. His name is Bian Shiming. Some people in the metals world call him Beyond, a Chinese billionaire trader known for massive bets on precious metals. Since 2022, he had already made more than $3 billion going long on gold, but silver was different. He believed the silver market had become a bubble, overheated, over-leveraged, and dangerously one-sided. So instead of buying, he prepared to short, and not just a little, just days before the crash. He built a massive short position, 30,000 contracts, equivalent to 450 tons of silver. Then the market collapsed. And from that single bet, he walked away with an estimated $144 million in profit in one move. But was he just lucky? Or did he understand something the rest of the market didn't? The official story. If you turned on financial news that day, you heard a very simple explanation. They blamed the crash on a stronger US dollar, a hawkish Federal Reserve Chair nomination, and fears of higher interest rates. According to the mainstream narrative, that was the entire story. Silver fell because the dollar rose. End of discussion. But that explanation leaves out something critical, because price didn't just drift lower. It didn't correct gradually. It collapsed in a violent, almost mechanical cascade. And that kind of crash usually has a deeper cause. The real trigger, a leveraged death spiral for months leading up to the crash. Silver had been on an explosive rally. Prices were rising fast, and speculators were piling in. Retail traders, hedge funds, leveraged ETFs, options traders. Everyone wanted exposure to silver, and many of them weren't using their own money. They were using borrowed money. Leverage. Leverage is powerful on the way up. It magnifies gains. But on the way down, it becomes a weapon against the trader. Because when prices fall, margin calls begin. And when margin calls begin, traders are forced to sell. Not because they want to, but because they have to. And that's exactly what happened. As silver started to drop, leveraged positions began to unwind. ETFs had to rebalance. Futures traders had to close positions. And brokers began issuing margin calls across the market. Then came the final trigger. The CME group raised margin requirements, which meant traders suddenly needed more cash. Just to hold their positions. Many couldn't meet the requirements, so their positions were liquidated automatically. And that forced selling created a cascade. Price dropped, which triggered more margin calls, which caused more selling, which pushed price down even further. A self-feeding loop, a leverage-driven death spiral, and within hours, the market collapsed. But here's where the story takes a strange turn, because what happened in the paper market did not match what was happening in the physical world. The great disconnect. On the futures exchanges, silver prices crashed to around $77 per ounce. That was the official market price, the number everyone saw on their screens. But in the real world, where actual silver bars and coins were being bought and sold, the story was completely different. In Japan, physical silver was selling for around $120 per ounce. In Shanghai, prices were near $111. And in places like Dubai and Switzerland, dealers reported something even more extreme. They had zero inventory, nothing left to sell. Think about that for a moment. The official market price said silver was under $80. But in some physical markets, it was selling for over $110 or even $120. That's not a small difference. That's a massive disconnect. And it raises a serious question. If silver is really worth $77, why can't you buy it at that price? Yeah. Unprecedented trading activity. The divergence didn't stop there. Just days after the crash, on February 5th, something extraordinary happened. In a single morning session, the Shanghai Futures Exchange traded paper silver, equivalent to nearly double the world's annual mine supply, in just a few hours. Let that sink in. 2 years' worth of global silver production, traded on paper before lunch. And yet, despite all that selling pressure, the physical price in Shanghai stayed high, the premium survived, the shortage remained, which suggests something important. The crash wasn't driven by physical metal. It was driven by paper contracts. And paper contracts can be created in unlimited quantities. Physical silver cannot. The structural reality of the silver market behind all the noise, behind the crashes, behind the leverage, there is a deeper story unfolding. For years, silver has been in a structural supply deficit. More silver is being used than is being mined. New mines take time, a lot of time. From discovery to production, it can take 7 to 10 years to bring a new silver mine online. And during that time, demand isn't standing still. It's accelerating. Silver is no longer just a precious metal. It's an industrial metal, a technology metal, an energy metal. It is used in solar panels, electric vehicles, AI infrastructure, semiconductors, defense systems. And unlike many other metals, silver has unique properties. There is no true substitute, which means demand isn't optional, it's essential, and that demand is growing every year, while supply struggles to keep up. So while the paper market was collapsing, the physical market was tightening, and the deeper you look into the silver supply chain, the more the imbalance becomes clear. For several years now, silver has been running a structural deficit, meaning the world consumes more silver each year than it produces. And this isn't a small gap. It's been building year after year, draining above-ground inventories, reducing stockpiles, and tightening the physical market. Unlike gold, which is mostly stored and recycled, silver is consumed, used, lost in industrial processes. Once it's built into a solar panel, or an electronic circuit, or a medical device, that silver is often gone forever, not stored in vaults, not waiting to be resold, just gone. And while supply struggles, demand is accelerating. The world is electrifying. Solar installations are booming. Electric vehicle production is scaling globally. AI data centers are expanding at record pace, and all of it requires silver. At the same time, governments and corporations have started to move, quietly but aggressively. In 2026, China officially reclassified silver as a strategic resource, and with that decision came export restrictions. Less silver leaving the country, more silver staying inside national borders, and tighter supply for the rest of the world. Then came another signal. A major tech giant, Samsung, locked up the output of an entire silver mine for 2 years, not because of speculation, not because of price charts, but because they needed guaranteed supply to keep production lines running, and they didn't want to risk shortages. Meanwhile, exchange inventories were falling. In Shanghai, silver stocks have dropped by 86% since 2021. COMEX inventories have also declined, and London's vaults have seen steady drawdowns. So even though the paper price crashed, the physical reality hasn't changed. In fact, the fundamentals may be tighter than ever. The leverage event versus the fundamental story. This is where the real distinction lies. The January 30th crash was a leverage event, not a fundamental one. The crash wasn't caused by mines suddenly producing more silver. It wasn't caused by demand disappearing. And it wasn't caused by warehouses overflowing with metal. It was caused by over-leveraged positions, margin calls, ETF rebalancing, and forced liquidations. In other words, financial mechanics, not physical reality. The paper market can move prices quickly, sometimes violently, but it cannot create real silver, it cannot manufacture supply, and it cannot fix a physical shortage. And that's why the disconnect after the crash is so important. Because normally, paper and physical prices stay relatively close, but this time, they didn't. The paper market said silver was worth around $77, but in the real world, you couldn't find it anywhere near that price, or at all. Dealers in multiple countries reported empty inventories, and physical prices stayed dramatically higher. That kind of divergence is not normal, and historically, it doesn't last forever. Eventually, paper and physical markets converge. The only question is, which one moves? Does the physical price collapse to match the paper market, or does the paper price surge to match the physical reality? The asymmetric opportunity. This is where the long-term silver thesis begins to take shape. Because if the physical shortage continues and industrial demand keeps rising, the paper price may not be able to stay disconnected forever. Eventually, contracts must settle, metal must be delivered, and shortages must be resolved. And if there isn't enough silver available at the paper price, something has to give. That's why some analysts and several major banks are already forecasting significantly higher prices. If gold enters a major bull market, some projections place silver between $133 and even $150 per ounce. Not because of hype, not because of speculation, but because of physical supply constraints and industrial demand, And this is what makes silver an asymmetric market. On one side, you have a paper market driven by leverage, algorithms, and financial contracts. On the other side, you have a physical market driven by factories, governments, and real-world demand. And right now, those two worlds are telling completely different stories. What the crash really meant, so what was the January 30th crash? Was it the end of the bull market, or just a violent correction? According to the structural data, it looks more like a reset, a leverage wipeout, a cleansing of speculative excess. And in many markets, that's exactly how bull runs continue. They shake out weak hands, remove leverage, reset sentiment, and then the long-term trend resumes. Because the underlying fundamentals didn't collapse that day. Solar demand didn't disappear, EV production didn't stop, AI infrastructure didn't vanish, and silver mines didn't suddenly start producing double the output. The physical world kept moving forward, exactly as it was before the crash, which suggests the long-term story may still be intact. The big question for 2026. So now the market faces a critical question, and it's the same question investors have asked for decades. Which market is real? The paper market or the physical one? Will the futures exchanges continue to set the price? Or will physical shortages eventually force a revaluation? Because if the disconnect continues to widen, at some point, something has to break. Either physical prices collapse or paper prices surge. And when those two worlds finally reconnect, the move could be fast and it could be violent. Final thoughts. The January 30th crash was historic. A $51 drop, $7 trillion erased. One of the most dramatic silver sell-offs in modern history. But beneath the chaos, a deeper story is unfolding. A story of supply deficits, industrial demand, strategic stockpiling, and a growing divide between paper prices and physical reality. And that story is far from over. So now the real question is, where do you think silver is headed by the end of 2026? Will the paper market stay in control? Or will physical demand force a massive repricing? Because in the end, markets can manipulate price for a while, but they can't manipulate reality forever.